going down these rabbit holes that ended up nowhere. So I am getting better at identifying which opportunities are fruitful and which are potentially a waste of time. So yeah, I guess that's kind of how that evolved.
So what about Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9-figure businesses. We interview top-level 8 and 9-figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9-figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. Now, most of you guys are going out there and you want maybe pre-revenue, maybe you want to scale, maybe you want to rock and roll, and you don't know what the hell to do. Well, that's the reason why I want to have this next guest on. Now, he is a very accomplished investor, but also he is the CEO and founder of Pycap. And we're going to be talking about that here shortly. But there are certain strategic consulting kind of questions you should be asking yourself during this process, like holistic business assessment, overall look at your business to understand challenges, potential opportunities for growth, cost reduction, and potentially uncovering new revenue streams, maybe new market opportunity assessment. Hey, is this a viable option? Is this going to be worth all of our time and energy? Maybe market messaging and assessment. Hey, how do we adjust this to make sure that we're obviously scaling at the highest level? Well, guess what? What if you had a full massive entrepreneurial team that comes right alongside you, be able to dial that in and have those conversations and be able to find those red flags before they become massive disruptors? That's the reason why I have this next guest on. Now, let me just share with you a little bit about his background. He is the CEO and founder of Pycap, which is just an incredible venture capital firm that provides financing and value creating solutions for early stage companies, administrative, investment, and management services for venture capital, for private equity investment vehicles. He is also the CFO of the ChargerQuest, a leading electric vehicle infrastructure company. And he has been featured in numerous different places like BloombergTV, BNN, Techvibes, Financial Post, Globe and Mail, Toronto Star, and so many others. Please welcome my next guest, the one and only Stuart Browne. How you doing today, Stuart?
Hey, Christian, great to be here. Thanks for having me on your program.
Well, hey, man, I'm really excited about diving into this because, like I mentioned, your guys' firm and venture capital firm, you guys not only just come in with the capital, which is very important, but you come in with this consulting ability as well at a very, very deep level. But before we dive into all that fun stuff, which we're going to be unpacking very, very quickly, I'd love to get your start, your journey, right? Be able to understand, and not just like the serendipities of life a little bit, but I want to talk a little bit about the hurdles, the difficulties, the pain, the things that were the most pivotal points in your journey that obviously led you to the success that you now currently have.
Okay, great question. It was, a lot of pain, trial and tribulations, like many entrepreneurs, in fact, most startups, when they become successful enterprises. So with me, I guess my journey started when I went to MBA school. And I studied to get into investment banking. So I learned everything I could about finance. But then when I graduated, it was 2009. So kind of the pinnacle of the subprime mortgage crisis. So literally the worst time to be getting into banking. The banks were hemorrhaging employees and cash. And when I would go into interviews, I would be thinking, I just killed it during the interview. I answered all the questions. I'm definitely getting this job. And then I see waiting to be interviewed right after me is someone with about 5 or 6 years on Wall Street working for Goldman Sachs, who had migrated from New York into Toronto to compete with MBAs that were looking for this to be their kind of entry point into the industry. So I was left in a situation where it was difficult for me to get the position I wanted, but kind of at the same time, I began to realize that I'm not really the type of person that would work for a huge corporation and be a kind of a cog in the wheel. Although I have huge amounts of respect for people who are able to become successful as an employee, for me, I found that I'm more of a entrepreneurial type person. And so I started getting involved with this organization called NACO, the National Angel Capital Organization. And I learned all about startup tech companies, entrepreneurs, and I really kind of fell in love with that world, because instead of competing with other MBAs, trying to climb on top of each other to get highly coveted positions, this world of entrepreneurship and startup tech was a lot more collaborative. People seemed a lot more passionate about these inventions they were creating. So I learned a lot about angel investing, and then that led me to learn about venture capital. And then I found an opportunity to create my own VC firm, and I just went full tilt with it, and had some challenges along the way, but eventually we became a successful organization, which brought us to where we are today.
So what I found so interesting is you guys, as the VC firm, are really dialed in to specific asset classes that you focus on, right? And I think that it's really, really impressive, because what I've noticed is those are the ones that are most successful, right? When they focus, because now your whole team, you're familiar with the industry, you know the numbers, you know the metrics, et cetera, right? So Stuart, when you were looking at it holistically and building it, what made you decide on those asset classes that you mainly focus on, compared to many of your other maybe colleagues that kind of have more of a industry agnostic approach?
Well, it's basically looking at an opportunity and evaluating it from a number of different perspectives. Like, you want to get into a company that has the right balance between risk and return potential. And that very much comes down to what's happening in the market as a whole, who the management team is, what their capabilities are, and many other things. If they have proprietary technology, working prototype, do they have traction? And if I see a company that has that kind of Goldilocks situation, and they need someone like myself to join the team, and they can use the value add that Pycap can bring to the table, then usually it's a good fit, and we will strike a deal with them, and then all kind of work collaboratively to grow the company.
So when you're looking at this criteria, this deal, okay, let's unpack this a little bit further, because I do know that, this is, correct me if I'm wrong, is this pre-seed or a pre-revenue?
It's a mix between, I would say, Series A and pre-Series A. So companies
Okay.
that are at the stage that they could receive VC financing, and other ones that are kind of at the startup stage that are more kind of a fit for angel investors.
Gotcha. Okay, gotcha. And that's kind of that's your criteria. So let's talk a little bit about pre-revenue, which is kind of the startup stage a little bit, right? So maybe their value prop is not fully dialed in. Maybe they don't have the full established kind of thing. And that's one of the reasons why you guys are able to kind of do a lot of business assessment in regards to market, the opportunity. Hey, is this even viable option? What's the growth trajectory? I'm just curious, when you're looking at, and like you mentioned, there's a ton of key points that you're looking at, and it's very contextual, right? And it tells a story. But I want to get an idea. I want to put, Stuart's head on brain in my head a little bit, and understand the way you look at a deal contextually. What are certain key points that you're saying, okay, hey, we got a management team, they've built businesses before, okay, cool, wonderful, I feel pretty confident in that, so maybe that gets a green flag. But then I look at the finances. Hey, you know what, they don't have a value prop. There's no we're not sure if this product is actually going to be selling, et cetera, et cetera. What are certain things? I'd love for you just maybe share us a little bit of contextual what you're looking at when you're looking at a company.
Yeah, absolutely. So if we're looking at the technology and the product, we like to target companies that are operating in a niche that is somewhat neglected or underserved. So for example, there was two Turkish guys that approached me, and they have access to some really exciting technology for an organic fertilizer. And apparently through their tests, they're able to generate yield that's 40% higher from a crop basis compared to what's currently available, and it's hyper organic and environmentally friendly. And so when you look at what's happening on the broad kind of macro level, the war in the Ukraine, Russia, sanctions, etc., there is a shortage in terms of fertilizer that's available in Canada. So it seems like it's a good kind of stars in terms of aligning for this type of an opportunity. So we look at the technology, we look at what's available in the market, and then we look kind of holistically and try to get that future kind of perspective of where the industry or the market is hitting. So that's on like the product and the technology side. But then when we look at the individuals, it's so much of selecting the right company to work with is based on psychology. And sometimes this is challenging for my Master of Finance students. So I'm a professor, an adjunct professor at one of the top ranking universities in Canada. And I teach MBAs and Master of Finance students. Of course, the Master of Finance students are very quant focused. They like dealing with numbers. They don't seem to like the touchy-feely stuff. But I tell them, like, it's the touchy-feely stuff, the psychology, that is what can be the most accurate predictor of generating high revenue and high growth and high return at the end of the day. And so from the individual perspective, to be honest, I like working with entrepreneurs that are ridiculously obsessed with what they're doing. Like if I'm hanging out with an entrepreneur and I find it challenging to talk to them about things other than their company and other than what they're trying to do with their product, I actually see that as a good sign.
That's interesting you mentioned that, because I've gotten a lot of people that I've talked to, and it's almost this intuition that you have, right? After talking, like Stuart, after talking to numerous founders, you know who has it and who doesn't. And you really can't explain it. There's this intuition. Are there certain characteristics or traits that you've identified that are kind of like holistic, in this, okay, hey, out of all my portfolio companies that are actually producing, these are the characteristic traits, et cetera, et cetera? Or I'm just curious, unpack that, because you do realize, and I'm starting to realize more and more how much VCs and PEs put a lot of emphasis on that team and those founders.
Yeah, absolutely. Because it's at the end of the day, it's humans that are running the company. And ideas are a dime a dozen. I've seen the most game-changing technology. Like I can mention it to you, and if I were to do that, you would say to me, Stuart, this is a product or a service that the world simply must have. And it's something that you would think would be a runway slam dunk success story, but the people running the company are just not entrepreneurial minded people. Like they might be very intelligent, they might be PhDs, but they don't have that X factor that allows them to execute on their vision. And an inability to execute on a vision will ensure that the company won't be successful. It does not matter like how great the opportunity is if the people with that opportunity can't execute on it.
Yeah, I appreciate you kind of sharing that a little bit. So do you find there, kind of looping back around, do you find that there are certain characteristics or, personality traits, or is it just, Stuart, is it just intuition? You've just talked to numerous people, who has it, who doesn't, and that's kind of hard to explain.
Yeah, you know what? It's kind of all of the above. And to be honest, like I have to admit, I think generally we as humans think that we have a good judge of character, and often we have that gut instinct that works for us sometimes. But other times when you're in business and in venture capital specifically, you have to make very important decisions based on very limited information. And when you're managing money on behalf of other investors, you have to be extremely careful on how you do that. And so things that I kind of look for to kind of mitigate the risk of failure while was at the same time trying to take advantage of the opportunity of return, you look for certain variables and clues to give you that insight to see if this entrepreneur has a potential to be successful. So certain things that you want to look for is if there's an entrepreneur who's trying to create a company, let's say it's in education technology, you want to make sure that they have domain expertise. So are they formerly an instructor? Have they created technology for the educational industry before at some other capacity, or are they involved in the educational industry in some other way, shape, or form that would give them that kind of added insight? Also, you want to look at their track record. Like what have they done in their past? Of course, the best indicator of success as an entrepreneur is to see, have they been an entrepreneur before and how did it turn out? But of course, that's not always the case, especially for first-time entrepreneurs. So you just kind of look for whatever data and information is available, and then you just try to make an educated bet on whether to invest into the company or not, and then just do whatever you can to make that investment a success. And then sometimes, of course, because there's a huge amount of risk, you're going to have failures. But overall, if you do it properly, you should be able to get more success stories than the failure stories.
Makes perfect sense. Now, I want to ask a little bit regards to kind of the next level a little bit. All right. You know, what I've noticed with when I'm talking to some companies where they're like, hey, we need to raise 40 million. And I'm like, where'd you get that number? Right. And so I'm always intrigued, you know, Stuart, I would love to get your response on, you know, how to properly assess, okay, how much do we need to raise in this period of time, in this phase where we're at? And then how do you have that conversation with those founders and those business people?
You know what? I really like that question because I see a huge blind spot for entrepreneurs is exactly that issue. Like, how much money do you need and what to do with that money? And so I've seen companies raise millions of dollars and then spiral out of control and fail. And then I see other companies like Pycap, for example. Like, we started with zero, and we're now at the stage where we're generating 7 figures in earnings, hopefully soon to be 8 figures. And this was over a long period of time, maybe 7 or 8 years that it took us to get to this stage. But what we've been able to accomplish using our own resources, in my opinion, I don't know, I'm impressed with what my team and I have been able to achieve in that regard. So when I hear companies telling me they need $40 million, one of my first questions is what are you going to do with the money? And then when they tell me, my follow-up questions would be, are you sure you really need that? Let's kind of unpack this and really understand, like, where can we get value without spending money as much as possible? Because when a company is in its early stages, it's very much in survival mode. And so they have to keep an eye on their burn rate and their runway. And the thing that they should be focused on the most, it's kind of like a race against time. They need to figure out how to generate cash flow and bring money in and break even before they get to the end of the runway. And if, you know, usually I pull up this graph for my students called the J curve. And right at the beginning of a company's life, when you look at their cumulative cash flow and it starts going down, before it starts going up and they break even, that period of time is called the Valley of Death. And the reason why it's called the Valley of Death is because that's where 90% of startups go to fail. And the failure rate, so we've been told over and over again for entrepreneurs and startups, is 90%. And honestly, why does a company fail? It's because it runs out of money, because it mismanages that exact question that you asked, like, what do you do with the money? Why do you need that much money? And of course, another thing that shareholders have to consider, whether you're an investor or you're the founder of the company, is dilution. Every time you raise money, you're going to be issuing shares of your business. You're going to be diluting yourself. You're going to be diluting the other investors. So one important question that VCs ask to entrepreneurs before they hand them over a check is, in addition to what are you going to do with the money, is how often are you going to need to go back to the capital markets and raise more financing? Like, do you really need to burn all of this cash? Do you need an office? Everything's virtual now. Do you need to do this massive marketing campaign? Do you need to hire these employees? What can we do without spending money? How far can we get? How far can we push that runway into the future so that we decrease the chances of failure as much as we can and give ourselves a lot more time to start generating that positive cash flow?
So let's talk a little bit about this. What other, and maybe you can share a case study or something like that, because I've heard people, like you just mentioned, where they were very resourceful. They needed maybe $4 million. And what was interesting, they already had existing clients, and a lot of their clients, they actually got a down payment of their service that they were already providing. So, you know, they bought it for 2 years, a 3-year contract. So then all of a sudden that was massive cash flow. So they didn't need to raise. And like you just mentioned, they didn't need to dilute and give up some of their equity. So I just find it very interesting. There are so many other different strategies. And obviously that's where, like you you mentioned, Pycap comes in handy because you have all these resources and all these other existent strategies and tactics that have already worked with other portfolio companies. Like, well, let's try this, let's implement this. So if you could, and I know you probably have a lot on your tool belt, if you will, but maybe just tell one or two that have been very, very effective. And maybe you mentioned a few already, but maybe just a few more.
Yeah, no problem. Okay, well, I'll talk about Pycap and our story and how we became where we are today with virtually zero resources. So a lot of the things that companies spend money on, they don't realize it, but they can get it for free. And they could use, as long as they're resourceful and they kind of take inventory of value that they could bring to the table, then they could leverage that and get things that they normally would pay for otherwise. So for example, Pycap, I had an MBA at the time. I was researching inside and out everything that there is to know about private equity and venture capital. And so I was coming up to this brick wall over and over and over again, trying to raise money for our fund because notoriously, the culture in Canada is very risk adverse. So no one wants to invest in venture capital, and those that do aren't willing to take a chance on a first time VC. So it was this chicken and egg scenario where it's like, how do I get experience as a venture capitalist and with my own fund when no one's going to give me money to do that? And so I had to surpass that hurdle by basically convincing the world about how much I know about venture capital. And that led to me approaching some of the biggest investor conferences in Canada, the owners of them, and just basically saying, look, I'd love to be a part of your event. I would love to have a booth at your event, but here's the reality of the situation. I don't have $10,000 to spend all in one day to have a booth there. But what I can do for you instead is I can make sure that everybody who leaves the conference will be talking about the insane technology they're going to see in our booth. And so the guy at the time was saying, well, what kind of technology are you talking about? And then I said to him, have you heard of virtual reality? And at that time, no one knew about virtual reality, especially, the people on this, what we call Bay Street, the Wall Street of Canada. And so he didn't know what it was. So I explained it to him. And he said to me, wow, that sounds insane. And I said, well, yeah, I could have a whole virtual reality setup in our booth. And I promise you, there's going to be a lineup of people waiting to get in. And so he said, okay, awesome. If you could pull that off, sure, I'll give you a free booth at our event. So then all of a sudden we have a booth for nothing at this event alongside with these massive publicly traded funds and these massive publicly traded tech companies. And here's our brand new VC firm. And I got the VR headset and other kind of technological demos happening in our booth because I was connecting with other startups. And I was saying to them, like, look, you want to raise money from investors? We're a VC firm. We're going to this investor conference. I could get you exposure to some of the most high net worth individuals in the country. Why don't you come into our booth and do demos of your product? And so that got us exposure. That led to many other things. I became a guest speaker at this event. I became a guest speaker at many other conferences. I was literally at the stage where I was getting paid to travel all over the world. Slovenia, all over China, Mongolia, Mexico, in the US, to get on stage and give presentations about venture capital and things that we were doing. And that led to me getting interviewed on BNN, like you mentioned, as well as BloombergTV. And all of this marketing, it's all PR. We're all using a bartering system that allowed us to get exposure and do that one critical thing that we weren't able to do prior, which is gain credibility in an area that we felt we had not built credibility yet. So then afterwards, when we started approaching investors to put money into our fund or get involved with our company, they had already heard of us or seen us on stage somewhere or seen us on TV, and they're familiar with us. So they already felt like they had some sort of a relationship with us. We positioned ourselves as subject matter experts, and that allowed us to start, getting into more and more interesting opportunities, which led to where we are today. So without doing this whole thing of using our resources and getting stuff for free here, there, and everywhere, there's no way I would be on this podcast right now talking about my successful entrepreneurial endeavor.
That's awesome, man. That's awesome. And I really appreciate you sharing that. Obviously, there were ups and downs during that journey. And, let me ask you regarding like Pycap a little bit further in that journey a little bit. When you are, filing through deals, we were talking a little bit about like, obviously you're able to ascertain kind of what that looks like in regards to, hey, the founder, what you're looking for. Though I'd love to talk a bit about like the conversation in regards to negotiation for that equity, whatever it is, hey, advisory, consulting, whatever it comes alongside. When you're having those conversations, I would imagine it has evolved now where now you have such a massive presence that now you have a lot of pull. And so you could go to you're kind of the gorilla in the table, if you will, and you've got a lot of resources and say, hey, well, I want this, this, and this. Before, though, you probably didn't have that kind of flexibility or that kind of gorilla mindset, if you will. So I'd love to talk to me a little bit about the evolution of that and now where you're at in this stage, how you're able to just impact businesses at a very, very high level very quickly.
Yeah, you know what? I think it was, I guess, being an entrepreneur myself and just grinding through it gave me that kind of insight. It also gave me the ability to have a broad network to kind of draw from, because we were spreading our net like as far as we possibly could. My philosophy going through this whole process was never leave a rock unturned. Like I will look anywhere and everywhere for business opportunities. That actually, sometimes turned out to be not such a great idea because I wasted so much time with pointless meetings and going down these rabbit holes that ended up nowhere. So I am getting better at identifying which opportunities are fruitful and which are potentially a waste of time. So yeah, I guess that's kind of how that evolved.
So what about the negotiation when you are helping this company come alongside a little bit in regards to kind of the actual structure of the deal? Okay, so you come in and say, hey, we'll help you raise X amount of dollars. Cool, wonderful. We'll also come and help you do consulting. I know it's very contextual. It's very dependent as well in regards to, hey, is it going to be equity? Is it going to be kind of a portion? Is it going to be kind of rev share? What does that look like?
Okay, so you know what? It really depends on one company to the other. Like there's so many variables that are at play. But broadly speaking, the main point of negotiation between an investor and an entrepreneur, of course, is the valuation. Like what amount of equity are you going to give up, given the amount of capital that the investor is going to bring in? And sometimes you want to get a deal done and you can't cross that hurdle because you don't have a meeting of the mind. So what venture capitalists can do is they could bring in other conditions within a deal using a preferred share agreement. That's always like the preferred way for a VC to invest because it has the latitude to bring in things like milestone financing or liquidity preferences or drag along, bring along clauses. All of those kind of rights and privileges, terms and conditions can be brought into the deal, can be used from a negotiation standpoint if you can't have a meeting of the minds in terms of the valuation. But I want to give just a little bit of advice to the entrepreneurs, because a lot of entrepreneurs I find might have the perspective that VCs are out to take advantage of them, use these kind of bag of tricks to manipulate them. And obviously there's a very extreme power dynamic in a lot of these situations. And if you're working with the right VCs and you kind of feel like maybe you're getting taken advantage of, I would suggest to the entrepreneur that you just take a step back and you try to look at the perspective of the investor. Because a lot of times I find entrepreneurs look at these VCs and they're like, okay, here's someone who's sitting on a massive amount of money. I'm this little struggling entrepreneur here. All I'm asking for is a couple $1 million. You're sitting on, $500 million. Can't you just help me out? And the thing is that the VCs, they obviously have a job themselves as well. They have a fiduciary duty to their limited partners or the investors that put money into their fund. And so when we enter into an agreement with our limited partners, so our investors, we have a certain investment thesis that we have to follow. So we're legally bound to follow that investment thesis. And that's not a fit for all entrepreneurs. And also the entrepreneur has to understand that the VC will have a different perspective that they do. They have an objective perspective, and they might not buy into the vision and the optimism of it as much as the entrepreneur, because they're not living and breathing it every day, and that could actually be a good thing. So I think, like any relationship, and it is a relationship, when an investment happens within the world of venture capital, the thing that helps that the most, I think, is just open communication between the investor and the issuer. So the issuer, the company raising the money, has to understand as much as possible, like how much risk this VC is onboarding by investing in this company, and identify that that risk is directly related to the value of the company and other terms and conditions they might be embedding into the deal.
What would you say, definitely with all this criteria that we just kind of talked a little bit about, the filters that you have established before you actually deploy capital and say, hey, we're going to go ahead and negotiate this deal. What would you say overall is the risk that is associated? Because, I know VCs kind of, it's the concept, and maybe your Pycap is a little bit different, and that's why I want to talk a little bit about it. But where it's out of 9 companies that they invest in, one actually produces, and that's kind of the unicorn that obviously offsets all the losses of the other ones. However, I'd love to just kind of talk a little bit about that if you're able to.
Yeah, absolutely. So I think holistically, the trends of the industry of venture capital, and I've kind of noticed this broadly over the last, maybe 5 or 6 years, is that investors are preferring increasingly to invest in companies with proven business models. So when I first started getting into this venture capital world, and there was all these stories of Mark Zuckerberg and Instagram and Uber, people were getting, the hype was kind of through the roof. Like, they want to invest in the next unicorn. They want to do what we call moonshoots, where you put money into a company that's pre-revenue, and maybe even before it's ever, exactly, starts generating revenue, it turns into a unicorn. So a company worth $1 billion or more. But speaking about that return potential obviously is significant, but then again, the risk potential is through the roof on those opportunities as well, because they're not proven. And so given what's happening in the market, the volatility that we're seeing on a day-to-day basis, that's causing investors overall to take less risk, because they're already exposed to so much risk within their personal portfolios. They want to make sure that they're able to achieve at least a certain amount of return from their VC portfolio. So they'll invest in companies that have more proven business models, that are already generating revenue. And if they don't have revenue, maybe they have other indicators like purchase order agreements, letter of intent, a huge amount of beta users on their platform that are providing very positive feedback and results, and giving an indication that if they were to flip the switch and start charging money, they would be willing to pay for it.
I appreciate you sharing that in regards to kind of like what that looks like a little bit. And I want to ask you in regards to non-negotiables when you come to the deal to have that conversation a little bit. What are non-negotiable? I know offline you mentioned you always want to have a controlling seat so that you can obviously deploy your strategies and really help them scale. I would love to ask other kind of non-negotiables when it comes to say, hey, if people are coming to you, Pycap, it's like, hey, this is what we're looking at, but also these are kind of what we want to assess, because we've have a proven model.
Yeah, for sure. Okay, just to provide a little bit of clarity, we don't actually want
So I really appreciate you sharing that, Stuart. And one of the questions I had real quick, kind of what I was just talking a little bit about, is non-negotiables when you're having this conversation with the deal. And I know some individuals are always looking for a controlling seat when they're obviously investing with a VC or a PE. Some individuals have just other non-negotiables. I'd love to understand Pycap and what you guys have when you guys are coming to that table.
Yeah, absolutely. Okay, so non-negotiables that we have is we have to have full access to all of their information. And that's not just a requirement going into the deal, but that's something that we require after the deal is made. So we need to be able to monitor the companies within our portfolio to know exactly what's going on with it so that we could be most effective in providing value to help grow the company. That's number one. But number two is, and this goes back to our fiduciary duty with our limited partners, it's our job to communicate to our investors how the portfolio is performing. So we need to be able to tell them intelligently, like, what are the activities that each company is working on. If there hasn't been an exit or the company hasn't started generating revenue yet, what other indicators are there that the company is creating value and increasing shareholder value? So all of those things are very important and definitely non-negotiable. There are other VCs that will require a seat on the board of directors. That is not the case for us, although we're open to have that conversation if the company wants us to be on the board.
Gotcha. And what about, let me ask you in regards to, like, certain equity, because we talked a little bit about dilution, and as they go through different stages of, raising capital, whether it's you guys helping them or whatever, is there like certainty that says, hey, you know what, we have a clause that says, hey, we have, X amount of equity and that's non-negotiable? Or I'm just curious, what does that look like?
Well, we don't necessarily have a clause that indicates how they should be raising capital or not raising capital, but we do try to get a sense of that before we agree to a deal. So we'll say to them, like, how do you plan on growing your company? What are you going to do with the money? At what stage are you going to be able to be self-sufficient and generating enough cash flow to kind of cover your own expenses? And if we receive answers that indicate they're going to continuously need to raise financing, and we don't feel like we're in a position to pay to play and maintain our pro rata equity position, then the question really becomes, is this company going to grow at a faster rate than we're going to be diluted? And if the answer is yes, we'll consider moving to the next stage of the discussion. But if not, we'll likely just pull out.
Now, I know this is contextual, it really depends, but is there like a kind of a baseline metric in regards to how fast you want to see the revenue outpacing the expense of that?
Yeah, well, what I would more so talk about in terms of a rule of thumb when you're looking for an investment opportunity as a VC is you want to invest in a company that has the potential to generate a 10x return within a period of 3 to 5 years. So regardless of how much revenue they're generating or even how much you're going to be diluted, you want to know as much as you can that if you're going to invest $1 million into this company, then you have a chance of pulling $10 million out of it within a period of 3 to 5 years. So so you look at things like, how is this company going to exit? Does it seem like the type of company that could appeal to retail investors, i.e., are they a good company to list on the Toronto Stock Exchange or the NASDAQ or elsewhere, so you can liquidate your position? Or is this the type of company that could be a target for a larger corporation to acquire it? And if they do, is this company going to grow sufficiently enough that they're going to pay 10 times the price that the company is currently valued?
So that's really the baseline benchmark, if you will, that you're looking at 10x, 3 to 5 years. Now, you mentioned exits, but before we dive into the exits and what your methodology is on that, which would you prefer, you mentioned deploy capital, and I want to loop back around on that because I think it's very, very important. When I'm investing into certain companies, I mainly focus in the SaaS world just because of the multiples. But with this, there are certain things that I'm looking at in regards to, hey, how are you going to use my capital when I invest into this? Hey, there are certain things that I'm looking for. with Pycap, are you guys looking for a particular thing in regards to, hey, this is going to R&D, this is going to infrastructure, this is going to more marketing sales, this is, are there certain things that like, hey, I like to see that, that's awesome, that's good news, or there are certain things that you don't? I'll have to unpack that.
Oh yeah, absolutely. Another critical question we ask entrepreneurs that are pitching us is exactly that. Like, what are you going to do with the money? And then we disaggregate every dollar they plan on spending of our cash into whatever activity. And we look at that and we ask ourselves, in regards to them spending this money into this particular asset or otherwise, is this alone have the potential to increase in value 10 times on its own, that one asset? And so if it's a fixed asset like a computer or desk or something like that, or a vehicle, obviously those depreciate over time. So if the company's going to get acquired, the larger company that's going to go buy it, they're not going to pay extra for something that's depreciating. So we don't like seeing money going into assets that are going to depreciate unless they're directly connected and required to generate the cash flow. So we do like seeing money going into research and development, because oftentimes that's what other companies want to acquire. They want to get that innovation, that proprietary technology that can't be gotten elsewhere. If the company is at a stage that it has solidified its business model, so it's no longer in discovery mode, like it's validated its value proposition and all those other segments within the business model canvas, then we think spending money on marketing as well as sales could be fruitful as well. But if we feel the company is a little bit too early and there's a good chance that the business model might deviate from its current position, then we don't want the money going to sales and marketing, because what they would be doing in that stage is basically educating a market and spending all this money and time on their business, which is going to then change at some point, highly likely in the future. And then they'll have to spend more money trying to re-educate the market to what they are now doing, or consider rebranding. And if they do that, all of the money they would have spent prior would have been a total waste.
Now, that's very interesting you're mentioning that, because I've heard different things that people look at depending upon each industry. It's like, hey, these are green flags, these are red flags of the way they're deploying capital. And I like what you said. You're making sure that when you were going into business, I wanted kind of a itemized invoice or itemized kind of process of like, hey, where are you deploying this capital? What does that look like? And kind of what's the result? And there are certain red flags in regards to what you're saying and buying depreciating items. That's excuse me. That's not what you're looking for. You're looking for, R&D, proprietary, maybe even the team, but also if there's a value prop going for that, marketing and sales on the front end, which is very interesting. Now, I do understand on the back end, there are obviously a lot of different exit strategies. Now, again, I don't know Pycap in regards to, do you guys prefer one strategy over the other? If so, what is the reason behind it?
It's always good to diversify your potential for return. So if I had a preference, it would be to invest into a company that can exit either through a strategic acquisition or through an IPO. But we just take a look at the opportunity. We take a position where we look at it from kind of a package approach. So if it's very strong in one regard, like it could be some blockchain security, AI platform that is very difficult for the general public to understand, and it's meant to be working in some back office of some huge bank where it's never to be seen the light of day with any retail customer. If the value in that solution is extremely strong, then we will be okay with foregoing the potential of the company IPOing, because the likelihood that it might be acquired by the bank itself is higher. So we kind of weigh different opportunities depending on each company.
Yeah, and I know we could because I know everything, a lot of these questions are very contextual and it makes perfect sense. And I understand that. And obviously I know we're not able to dive into each one, each case or each portfolio and kind of what you're looking at, but it would be a really cool conversation another day to be able to dive into, say, hey, like, let's take a look at this case study. Let's unpack that. Okay. Why are you thinking, IPO compared to obviously an acquisition? And like you mentioned, there's a lot that goes into a lot of, numbers, a lot of, conversations, and maybe just the opportunity just presents itself and so forth. And you still get that good multiple on the back end. So, man, I really appreciate this conversation today, just unpacking this very high level, understanding, Pycap's journey. I think it's just incredible what you guys bootstrapped, but you guys, you, Stuart, you just were very resourceful. You went out there and worked like hell and made some incredible connections and negotiated and had some good conversations. But now you've been able to help so many portfolio companies and really being able to establish that next level, which is very exciting. Stuart, if my audience wants to, because you have a really cool education content on your website as well, other content available outside of just the VC world. How can my audience reach out to you and be part of what you got going on, Stuart?
Absolutely. Well, they could just visit our website, www.pycap.com. So that's pycap.com, or they can email us at info@pycap.com.
Awesome. And guys, those links will be in the description below. Also, I'll put his LinkedIn information as well, so you can connect him with there. But he's actually got a really cool academy on his website. That's the reason why I mentioned that. When that academy has a whole bunch of resources, because he's a professor at some really high business schools, he's been able to kind of leverage that same education, which is really, really sweet, because it goes much more than just, relationships, but also, hey, really understanding the VC world at a very high level. So guys, those links are in the description. Stuart, I really appreciate your time being on here, man. I learned so much, and I know our audience has learned so much as well. I always like to ask my guests before I let you go, is there any last words of wisdom that you'd like to share with our audience?
Yeah, I would just say that keep working, and keep grinding, the standard kind of stuff, but do it in a smart way. Like, always look for validation. Don't just put your head down and think that if you're going to work as hard as possible with one particular business idea, it's going to be successful. Be more focused on, solving the problem and understanding your customer segment and servicing them, and be kind of passionate about the problem as opposed to the solution. And that will ensure that you get on the right track to make your company successful.
Well said, guys. That is the CEO and founder of Pycap, the venture capitalist, my friend, the one and only Stuart Browne. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review, and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback, and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.